Be Wealthy and Smart, episode 1650.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the stock market almost back to the highs where it was before the Iran war. Now, this is significant because we've had kind of the echo market like we had the year before when the president declared Liberation Day. And while many people had been calling for a complete breakdown or crash in markets, I felt this would be an echo of what happened last year, a sharp downturn with a fast rebound. And that's what we're seeing right now. The S&P 500 crossed over 7,000 today, and the all-time high was 7,002, reached on January 28th. Now, this put the S&P 500 at up just 2.14% for the year, but that's a lot better than having a negative return. And in the last 12 months, the S&P 500 is up a whopping 32.55%. The Dow Jones Industrial Average is up 0.59% year-to-date and 21.83% in the last 12 months. And the tech-heavy NASDAQ is up 2.53% year-to-date and 46.14% in the last 12 months. Now, in between all of this, there's been a lot of volatility with the price of oil, with talk of war, etc. But in the end, the stock market is really about earnings. What is the profitability of companies? And this year, it's projected that earnings will run at a rate of about 17% gains on average. That portends for us to have a spectacular year by the end of this year. Now, in terms of news-driven events, there's a lot of talk about, is this the end of the war? Is this not the end of the war? And that will continue to bring volatility into the markets. But if we get the message that the war is really over, expect that this market will take off and shoot up. So this is not the time to be fearful and on the sidelines. Not that we won't continue to have volatility, of course we will. And there is a gap in the S&P 500, which means we do have to go back down and fill the gap at some point. But that's the normal price we pay to have higher returns is volatility. To put up with volatility means that you have the opportunity to have volatility on the upside. And that's why it's so important to invest when it feels most uncomfortable to invest. When markets are down and it feels like they're just going to continue to go down, and maybe you invested and they did continue to go down for a period of time. That's okay. It's nearly impossible to buy at the exact bottom. Nobody can do it, not even professionals. But what you can do is take advantage of prices while they're lower and look to the future on a 1, 3 to 5 year time horizon and know that you've likely gotten a good buy. It's usually bad news and uncertainty that creates stocks and their prices being on sale. In this case, we had increased geopolitical uncertainty. Ross Mayfield, Baird investment strategist, said, "I don't want to rule out that there could be a re-escalation and more downside from here, but I think it's unlikely. I think the market is already pricing in some level of anxiety about Iran. It seems that we're back near all-time highs with a much cleaner positioning incentive and backdrop, and on the heels of an earnings season that should kind of facilitate some bullishness as well." What also helped was we had statistics come in that looked better than expected. The Producer Price Index rose in March. That's a gauge of pipeline costs for final demand goods and services, and it increased a seasonally adjusted 0.5% for the month, which is well below the estimate of 1.1% by Dow Jones Consensus. The increase on the producer end of prices was less than the 0.9% gain in prices consumers actually paid for the month, and core consumer prices also were soft, rising just 0.2%. Putting together the consumer and producer price indexes and how they feed into the PCE inflation reading, Bank of America estimated that March will be around 3.1% annually for headline and 3.5% for core. That compares with respective levels of 2.8% and 3% in February. Economist Stephen Junot of Bank of America said the trends should keep the Fed firmly on hold in the near term, meaning no hike in interest rates. As expected, energy was the primary culprit in the producer price index gain. The gas index surged 15.7%, accounting for about half the gain in the PPI. Diesel prices alone soared 42%, while jet fuel was up 30.7%. Fed officials have expressed some caution about the war's impact, but generally see inflation continuing to ease through the year on its way back to the central bank's 2% target. Currently, markets are pricing in about a 25% chance for a cut through December. But mostly, markets are expecting the Fed to stay on hold with interest rates throughout the year for right now. I'm still expecting interest rates to go lower, and that might be a result of a new Fed chairman, or it could be a result of lower oil prices. But what we do know is the U.S. Treasury pumped $84 billion in liquidity last week via TGA release, and in 2 weeks, the Treasury has pumped $182 billion into the economy. That kind of massive liquidity should find its way into lower rates and booming asset prices. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.